Hey everyone, this is your host Chris. Still on my program trading binge. I am going to talk today about the RSI, also known as the Relative Strength Index. Now, the Relative Strength Index, you could basically find it on you can find it almost everywhere. It's one of the most commonly used oscillators or studies that people use to analyze stocks. Now, what it is I'm going to flash this. We'll close up the GE a little bit, get rid of that volume. Here's the RSI, and if you notice here, right over here, RSI parentheses 14. That means it is the 14-day relative strength index. All right, and that just means in the calculation that we are using 14 data points. And here are the formulas in case anyone is interested. RSI equals 100 minus the quantity 100 over 1 plus RS, and RS equals AU minus AD. And as you see, here are what AU and AD are. I know variables, they always confuse you, but this is just the total upward price changes in the past X days, and this is the total of down price changes, okay? So the entire index, you really don't need to know the formula unless you're actually being tested on it, because most programs have it already built in. But the way that the inventor Wells Wilder used it, the first thing was he constructed overbought and oversold lines, as we see by this red line and this red line. Now, the bottom red line is the oversold line, and I have a little label there, and the top red line is overbought. All right, so pretty simple so far, and it just bounces between these values depending on what the formula tells the value is going to be for that day, and eventually we have our own little chart. Alright, now next thing, just a little note before we get into the studies, like how to use and how to trade with it. Oscillators like the relative strength index, like momentum, like volume oscillators, like what else? I know there's another one, stochastics. They all tend to lead the market movement. Okay, so keep that in mind. It normally is before a price movement that you see a top or a bottom in an oscillator. Anyway, we're going to get rid of this here, and I'm actually going to close this up, this top half, so I can barely even see where it's moving. So I'm going to pick out what the buy and sell points would be if I was trading with different methods, and then I'll evaluate its profitability. Okay, first, since this is the 14-day, what I found best is not the 70 and 30 level for the overbought and oversold levels corresponding, but I like to use, since also I'm a little more conservative, I like to use the 73 line, which is going to be this blue line, and the 27 line. And as the time period gets shorter, generally you want the levels, I think I'm saying this right, please correct me if I'm wrong, but I think this is right. You want the levels to get shorter. And I'm going to actually check that just to make sure. Go with the 2-day. Take that back, I was totally wrong. We want it to be wider when it's a shorter term because volatility is higher. My bad. Okay. Go back to the 14-day. I would never use a 2-day unless I was day trading. But anyway, here's what we got, and I'll construct this line at the bottom again. And we would buy, here I'll put the signals in, we would buy when it would get to the oversold levels, and we would sell when it gets to the overbought level. So we would buy there, we would sell. Actually, nope, I'm using the blue line. So we would buy there, and we would sell here, and then we would buy here, and we would sell here. Alright, let's see how that works for us. I'm going to move this back down again, and I'm doing this totally impromptu, so I do not know which method is best so far. So that tells us that we should buy, or we would have bought right there, and we would have sold right here, which gives us about I'm drawing with this brown line, that gives us from $14 to $17.50, so $3.50, which equates to about a 17% gain in 1, 2, 3, 4, 5, roughly about 5 months. That's pretty good. And then we would sell there, we'd stay out of the market, we would have avoided the crash here. Alright, we would have avoided the crash, and when it would cross this level, we would have bought, and this would give us an excellent entry point, because as we see, it is at the exact bottom of the movement. And then we would hold on to it, and we would sell right here. So as you see, I'll draw this line. This gives you about a 10% profit but as you see here, it keeps you out of the market for a bit, and you do miss out on a lot of the good price movements. Like, you missed out on an extra 12% gain at that point, and you would have been out of the market right now. So at this point you missed an extra, actually take that back, because it went back down, as you see, so you'd be even there, but you do miss out on a bit. So that's one method. Not saying it's the best, but not saying it's the worst, because every situation is different. So I'm going to delete my drawings again, and we're going to do the second method, constructing trend lines. Okay, trend lines. When you have a trend line, you draw the trend line in a downtrend, and we're going to treat this just like a stock chart. In a downtrend, you draw the trend line across the tops. In an uptrend, you draw the trend line across the bottom. So here's first trend line. There's our first trend line. Our second trend line. Let's check I go with this one. Sure, I'll go with this one. 1, 2, 3. And then the next one, we're in an uptrend. That takes us to about there. And the next one, we're back in a downtrend. Takes us down, down, down. And actually, I did that one wrong. There we go. Down, 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 down. And then we are, once again, uptrend. One was a little rough. And then finally one more uptrend. It's not as strong, but still. Okay, so now we're going to go in order here. At this point, we would be out of the market because we have no trend line to precede it. And we're using the one-day chart of General Electric, just FYI. Symbol is GE. We would buy here, and then we see this moving up, and we would buy there. We'd go until the trend line is broken, and we would sell here and then sell short until here, where we would buy back again, get back into the market. We would sell there, buy here, and then this one, since we're already in the market, we would buy again there. No, we would short sell there. And then we would cover our short, go long again, and then we'd sell here. Okay, so I'm going to quickly calculate the profits or the loss. Just give me a second, alright? I'm going to pause. Okay, I'm back. I did my calculations. We have, this is our first long, and just go with the chart. Long means we're buying, short means we're selling, and then selling short. You are always in the market on this. Long. We go, that's our first long, this is our first short, second long, second short, third long, third, am I getting this right? Hold on a sec. Here, let me start one more time. This is our first long, from here to there. This is our first short, from there to there. This is our second long, from there to there. Our second short, from there to there. Our third long, from there to there, our third short from here to here, and then finally, when we're done, we do our last long, which is from here to here. And as you see, our profit that we're basically racking in here, our last one, let me fill that in, 1450, we got about 1450 to around 1725. It's about, okay, anyway, we add these all up. $2.50, we have $3 and no, $2.50, $5.75, and then we'll move to the next one. We got a 0, $5.75, then $8.25. Please forgive me if I'm doing this wrong. $8.25, and then $8.25 finally, plus $2.35 equals $10.60. Okay, we have a $10.60 gain. $10.60 gain on the stock. So, needless to say, with our $10.60 gain versus our other gain that was roughly about 18% versus our about 50%. This one's obviously a better method. This one you just do the trend lines, do the trend line analysis, and actually I want to point out one special case. See this right here? I'm going to zoom in. I'm going to zoom back out. My bad. I probably shouldn't have done that. Okay. Gonna move this. Get rid of this drawing so I can clear things up for you. Sometimes chart patterns appear on a relative strength index or an oscillator, and it's a rare occurrence. But I just want to tell you, when it does happen, you absolutely need to just take heed of it, because when it does happen, we have large moves. And as we see here, this buy signal made by this symmetrical triangle formation brings us from, this was our largest move in the entire trading session. Brings us from about 1550 all the way up to about $19. That gives us a $3.50 gain, or over, say we bought at 1550, that gives us a 23% gain. And this also holds true for when the market or the relative strength index is in a downtrend. Just always listen to it, stick to your guns, trade the chart, and remember, this is a leading indicator, so when the market's going up, your relative strength index or your oscillator is going to quietly say you should get out of the market right now. And generally you should listen to it. Alright, so hope you learned something. Of course, any questions, please post in the comment box or email me at the radio station wpsh@psu.edu. And by the way, the radio show, if you ever want to call in, it's Monday and Wednesday, 4 o'clock to 5:30. We talk politics, personal finance, and a little bit of health and nutrition. And you can listen anytime at wpsh.net. All right, thank you for watching.